Another lender just went under. And the list of U.S. financial failures is quietly getting longer. PrimaLend Capital Partners, a Texas-based subprime lending, filed for Chapter 11 bankruptcy on October 22, 2025, listing between $100 million and $500 million in assets and liabilities. This marks yet another sign of stress in the credit market, especially among subprime auto and consumer finance firms, the riskiest corner of the lending world. According to the Federal Deposit Insurance Corporation, the U.S. has now recorded 4 official bank failures since 2024. 2 last year and 2 so far this year. While these institutions were getting smaller in size, the growing frequency is what analysts are watching. Each failure adds pressure to regional lenders already coping with higher funding costs, deposit outflows, and weaker loan performances. Put simply, it's not just 1 or 2 banks anymore. It's starting to look like a pattern. When economists talk about systemic risk, they're not talking about a single collapse. They're describing shared fragilities, the same problem repeating across different balance sheets. That includes borrowing and falling behind on payments, banks holding illiquid assets that they can't easily sell, and investors demanding higher yields to take on risk. When those vulnerabilities start connecting, you get a credit contraction, less lending, tighter money, and slower growth. That's when isolated failures start turning into systemic events. The financial system is built on confidence. Once that confidence cracks, liquidity disappears first, and risk assets follow. Historically, when the bank stress clusters like this, the markets follows a predictable chain of reaction. 1, regional banks and high beta stocks fall first. 2, credit spread widens as lenders pull back on risk. 3, treasuries, golds, and the US dollar attract inflows as safe havens. And 4, earnings estimate drops across the board as credit tightens. That's the setup for market repricing. Not panic, but an orderly retreat from risk until policy steps in. The Federal Reserve is in a tight spot. Inflation is still above target, which limits rate cuts. But financial stress is building, which demands liquidity. The Fed's next move will depend on how deep these cracks run. Expect more attention on deposit flows, money market fund inflows, and potential extensions of liquidity programs to the 2023's Bank Term Funding Program. If more regional or specialty lenders stumble, we could see fresh intervention, not to rescue banks, but to protect the stability in credit markets. For traders and investors tracking the systemic risk, watch these indicators closely. KRE, Regional Bank ETF, stress parameters for smaller lenders. The credit default swaps on mid-tier banks, fear gauge for credit risk. The high yield bond spreads, it's a signal of tightening liquidity. The money market fund inflow, a proxy for depositors' flight. And the commercial real estate delinquencies, next possible fault line. All of these are early warning signs. If they trend together, markets may start pricing in broader slowdowns well before official data confirms it. We've had 4 bank failures in the last 2 years, which might not sound like much, but history shows these moments rarely stay isolated. When credit tightens and confidence fades, systemic risk moves from the background to the foreground and becomes center story. For now, the key question is simple. Are we seeing isolated stress or the early phases of another financial tightening cycle? You've been watching the Raw Report, where money meets news. Make sure to like, comment, and subscribe to stay up to date with news that hits not only the markets, but your wallet. Again, thank you all for watching, and I'll see you in the next episode.